Greetings to all. Welcome to our weekly market outlook video. So in this video, we are going to have a very short overview on the market valuations and how things are placed after having a very turbulent weeks in last 15 days. So let's start. So in last 15 days, we have seen some pressure from the top, be it large caps, that is Nifty 50 or Nifty 100. Then the trouble is more into the mid caps and small cap space, where we have seen a very stellar run in last year, and then we had some statements from the SEBI's chairperson, Mr. Madhvi, that she said that there are some signs of formation of the bubbles. And again, there was a narrative into the market regarding the stretched valuations and the recent stellar runs into the mid and small cap space. So, of course, we are going to look at those things, how mid and small caps are placed. And again, we have also seen pressure on the Nifty 50 and the other large caps as well. So here is our 1 year forward price to earning chart of Nifty 50. So Nifty 50's 1 year forward P is now quoting at 21x. And the median has been from last year, last 10 years, it has been 20x. So there is a 5% premium to the 1 year forward P. So the of course the premium is not very stretched if you look at the chart. In fact, the premium goes on towards 25%. We are now at just 5% premium to the historical median. So on Nifty 50 side, it looks very good. So Nifty 50 price to 1 year forward price to earnings ranges between 17x to 23x, and we are now putting at 21x. This is the Bank Nifty's 1 year forward price to book. There has been a regime change post 2019. If you look at 2014 to 2019, it used to quote at 2.5 times to 3 times. And after the COVID, it hasn't, the 2.5 times has become the upper band of the price to book for the most of the banks. And now they are putting at 2x of their book value. So definitely the pressure on the banking side is there. We have also discussed this chart in the last video as well, and there has not been much change into the Nifty banks. We have seen some positive movements, be it Axis Bank, ICICI Bank, and HDFC Bank from our last video. These banks have stable. In fact, they have been a backbone of the large caps or the Nifty 50 in recent turbulence. So, of course, the valuation support is there. Banks haven't performed relative to the large cap. So definitely banks are expected to do well in the coming times. Then let's move on towards some interesting charts. So we are going to see some ratio charts. So here is a ratio chart of small cap 100 index to the Nifty 100 index. So Nifty 100 index is a large cap index, and that's we are going to compare with the small cap. That's we are going to compare relatively with the small cap 100. So here is the ratio chart. The ratio chart has approached the resistance level. In fact, we have seen some inflections from this kinds of levels historically, be it 2010, 2014, 2018, and there was, of course, the 2021 as well. And in the start of the 2024, we have been cooling off from those same levels. So the recent fall in the small cap 100 index or on the broader basis is more towards its outperformance with the large caps, and now it was approached its inflection levels, and from that we are seeing some cool off. This is again a ratio chart. This is one with the mid cap 100 and the Nifty 100. Basically, we are going to compare the mid caps with the large caps. So mid caps has been a quite good performer. In fact, if you look at the small caps ratio, it is moving into one band. But the large caps are trading secularly on the one side. In fact, there has been no any band or the trading range band as far as this ratio chart is concerned. The mid cap performance relative to the large cap has recently marked its all-time high from the 2003. So clearly, the move is more into the mid cap 100 index relative to the large caps. And again, if this situation persist going ahead, then we can see some more meltdown into the mid cap 100. And lastly, this we are going to compare large caps with the broader market, that is S&P 500. So if we exclude the Nifty 100, then we left with the 400 companies, which includes mid caps and small caps. So both of this broader market spectrum we are going to compare with the large cap. So the relative underperformance of the large caps compared to the mid and small caps is now at the level when it was lastly seen back in 2005. That's the kind of underperformance large caps have done relative to the broader market. And in fact, there has been a sharp jump from last 2 months in this ratio, as we can see that from the chart. So definitely the underperformance in large caps is there as far as the broader markets are concerned. And the large caps 1 year forward price to earning we just saw at the start of the video is also not that at premium. In fact, it's trading at only 5% premium versus 25% seen at peak in as far as history is concerned. So definitely large caps are expected to do well in the coming times. In fact, in the coming turbulent times. So we also released our report supporting the large caps back in October 2023. So that reports has also corroborated with this view. So definitely one can look at large caps seriously. So I hope this facts are clear to all of you. Let's end here. Thank you all and have a very happy weekend ahead.